Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. The 60/40 portfolio was introduced nearly 70 years ago, and in a low interest rate environment means we need to get more creative. Times have certainly changed, and the new benchmark is 33-33-33 with your assets divided equally between stocks, bonds, and alternatives. Joining us to discuss is Tyler Robuck, Managing Director and Financial Advisor at Manhattan West. Tyler, it's great to have you with us. Welcome to Trade Talks.
Good morning, Tyler, Jill. Thank you for having me on.
You got it. Let's start with alternative assets. What are they, and why should investors consider them for their portfolio?
Sure. Well, alternative assets are really any asset that's not traditionally in a liquid portfolio consisting of just stocks and bonds. Things like real estate, venture capital, private debt, private equity, and even today, things like crypto. And they're important to have in a portfolio because they provide diversification and they also provide stability. The goal is to really be able to provide our investors with returns in all market conditions.
And we've seen recent sell-offs in technology specifically and other sectors. Why are venture capital, real estate, and private equity attractive to investors in the current state of the market?
Sure. The answer to that question is really twofold. Well, we're seeing a huge sell-off right now, obviously, because of geopolitical pressures. But if you add some alternatives, it really adds stability and diversification to your portfolio. So as markets are wavering wildly right now, the private debt and real estate is staying stable in clients' portfolios. So it adds a bit of stability to clients. But historically speaking, we're on a 10-year run of a bull market. Interest rates are at historically low rates right now. So that really doesn't leave a lot of spaces for investors to go. So if you're in a traditional portfolio consisting of just stocks and bonds, you're really sitting in a target. So our goal has always been to provide access to asset classes and alternatives where investors can still achieve returns given where we are. I mean, I don't think there's an analyst in the world that's going to say bonds are going to do well in the next 5 years. So go ahead.
Yeah, Tyler, let's talk more about that. You are a proponent of the 33-33-33 portfolio, replacing the traditional 60/40 as the new benchmark. Explain to us what that is and why it's better than 60/40.
Absolutely. So the 33-33-33 is 33% equities, 33% bonds, and 33% alternatives, broken up into different sectors. At Manhattan West, our alternative allocation consists of private debt, private equity, venture capital, real estate, and digital assets. So it's important because most of the research these days, including JP Morgan's Guide to Alternatives, is showing that if you add just 30% of alternatives to your portfolio, you dramatically increase your potential for returns and reduce the volatility as well.
And why does Manhattan West position portfolios this way? How is it benefiting your clients?
Well, if you look at the smart money and the big money, like endowments and pension funds and family office, all of them are investing this way. It may even be half alternatives. So it's really important to have access and for our clients to gain access. So it was our founder's vision from the beginning to give high net worth clients, and I mean clients, 3 to 20 million, the experience of $100 million client, or an endowment fund. So that's really been our goal at Manhattan West, is to provide that type of access and that investment structure for our clients.
And I was just going to ask you that question. Traditionally, it's those high net worth accredited investors that have access to it, but it sounds as if it's more democratized now, if you will. And I also understand that your firm has alternative funds managed in-house. So can you explain Manhattan West's investment approach?
Absolutely. Well, there's really an alarming trend in our industry of consolidation. We're having, billions and billions of private equity dollars pumped into our industry to fuel this mad purchasing spree and consolidation of firms. And the net result of that is that they have to figure out a way to manage portfolios across a broad array of clients. And the result of that is very kind of standardized model portfolios of stocks and bonds. And as we see where we are today in the market cycle, this really isn't helping clients. It's such a commodity to have a 60-40 portfolio. Robos can do it. I mean, you can get it anywhere. So it's really not. So our goal has always been to provide clients returns in all market conditions. And the way to do that is with adding alternatives to your portfolio.
And finally, Tyler, how can we learn more about Manhattan West?
Absolutely. You can go to www.manhattanwest.com, learn a little bit more about our approach and our team. And I really want to thank you for having me today.
You got it, Tyler. And we thank you. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you. Have a great day.